All right, let's change the way we talk about SEO. For too long, it's been buried in the marketing budget as just another expense. Today, we're going to pull it out of there and reframe it for what it truly is, a strategic capital investment, one that's designed to build a real, lasting asset for your company.
So let's start with a really fundamental question for any leader. When you look at your marketing spend, do you see a cost center or do you see a growth engine? Because your answer to that question completely changes how you approach a decision like investing in SEO.
So here's our game plan for this briefing. First, we'll redefine SEO as a strategic investment. Then, we'll get into how it's priced based on value and business impact. We'll look at the different investment tiers, break down the key factors that drive your return, and then map out a realistic timeline for growth. And finally, we'll talk about the real endgame, building a sustainable asset for your business.
Okay, first things first. We have to get past the idea that SEO is just another monthly line item. The right way to look at this is as an investment in a durable digital asset, an asset that actually appreciates over time. Think of it this way. It's less like renting a billboard for a month and a lot more like buying the land that billboard sits on.
So what is SEO in language that matters to the C-suite? Forget the jargon about keywords and backlinks for a minute. At its core, it's the strategic process of building a digital asset, an asset that does two things really well. It consistently generates qualified leads for your sales team, and it builds your brand's authority in the market. That's a definition that ties directly to the bottom line.
So how do you price something like that? Well, it's definitely not about picking a generic package off a shelf. A serious approach uses a value-based model, where the investment level is directly aligned with the specific business impact you're trying to make.
And that value isn't just pulled out of thin air. It all starts with your specific business objectives. Are you after more leads, higher revenue, dominating market visibility? From there, it factors in how competitive your market is and the actual scope of work needed to win. A good model is always going to be transparent and built to scale right alongside your business.
Given that model, how do you decide where to actually allocate capital? Let's stop thinking about these as packages. They're distinct investment tiers, and each one has a clear business case and a predictable outcome. It's about choosing the right tool for the job.
It breaks down pretty clearly. At the foundational level, around $500 a month, that's really ideal for maintaining and slowly improving your visibility, especially in a low-competition space. When you step up to $1,000, you're funding a proactive growth strategy. You're going to see noticeable traffic growth and lead generation. And for those of you in really tough, competitive industries, an investment around $1,500 a month is what it takes to seriously pursue market leadership and build a truly scalable sales pipeline. Now, of course, those tiers are just a framework. The right investment for your company depends on a few key variables. And I want you to think of these not as roadblocks, but as the inputs that make up your company's unique ROI equation.
So what are those variables? Well, first, how competitive is your industry? Are you in a Shark Tank like law or finance? Where are you targeting geographically? A dense city core or a wider suburban area? What's your starting point? Is your website in good shape or does it need an overhaul? And frankly, how fast are you expecting to see results? The answers to those questions really define the level of investment needed to win.
And that brings us to a really common and frankly costly misconception. The myth is that SEO is a one-time project. You just set it and forget it. But the reality is that SEO is a continuous investment. You're not just fixing something. You are actively nurturing and growing a valuable company asset. And that requires ongoing attention to protect its value and keep it performing.
The next logical question is always, okay, so when do I see a return on this investment? And that's a perfectly fair question. The answer isn't it depends. There's actually a pretty predictable timeline with clear, tangible business milestones along the way.
In the first 3 months or so, all the foundational work gets done. You'll see early indicators like more search impressions. That just means your brand is showing up more often. By the 6-month mark, that starts translating into real results, noticeable ranking improvements, measurable traffic, and, most importantly, qualified leads hitting your inbox. Then by the 1-year mark, that asset is really humming. You've got strong first-page rankings delivering a sustainable inbound lead pipeline.
So let's bring this all home. The bottom line, the ultimate goal here is about building a sustainable asset that secures your long-term competitive advantage. This is about building a competitive moat around your business in the digital world.
And here is the ultimate payoff, the thing that should make every CEO lean in. A well-run SEO program becomes an owned, sustainable channel for acquiring new customers. And over time, that systematically reduces how much you have to rely on paid ads. It drives down your customer acquisition cost, which in turn increases profitability. You're building, not renting, your audience.
This quote from the Toronto Business Guide just nails it. Understanding SEO investment isn't about hunting for the lowest price. It's about recognizing the strategic value of an approach that is tailored to your business, totally transparent, and absolutely relentless about driving results.
So I'll leave you with this. The question you should be asking isn't really how much does SEO cost? The strategic question, the one every leader needs to be asking themselves is, what is the cost of not investing in our digital future? What's the real risk of letting your competitors build these powerful assets while you stand still? That's the real cost to think about.